Welcome to Test Portfolio XSX. Today we dive into the latest US stock market trends and Trump's trade moves. Let's get started. Welcome to the Test Portfolio XSX YouTube channel. This video was created with the help of artificial intelligence. This is not financial advice. The video reflects my personal opinion based on publicly available information, so errors may occur. Let's review how US stock markets performed during the week of May 5th to 9th, 2025. US equities saw slight declines this week. The S&P 500 fell by 0.5%, the Dow Jones Industrial Average by 0.3%, and the Nasdaq Composite also by 0.3%. The Russell 2000 Index, which tracks smaller cap companies, rose 0.1%. This relatively stable performance reflects cautious investor optimism ahead of US-China trade negotiations. Let's now take a look at the key news and developments that shaped US markets during the week of May 5th to 9th, 2025. News number 5. Pressure to raise the US debt ceiling. Date, May 9th, 2025. Source, letter from Treasury Secretary Scott Bessent to Congress. Stakes, the US national debt has reached $36.2 trillion, surpassing the statutory ceiling of $36.1 trillion. Why it matters, according to the Treasury Department, the X-date, when the government would run out of funds, is projected for August. Since Congress will be in recess in August, a decision must be made by mid-July. Without raising the ceiling, the U.S. would be unable to meet its financial obligations, posing serious risks to financial markets, national security, and the country's global leadership position. Political context. With a Republican-controlled Congress, the GOP is pushing a $5 trillion package that includes a debt ceiling increase, tax cuts, spending reductions, and increased funding for border and national defense. Their goal is to pass it by July 4th. Democrats oppose tying the debt ceiling to other policy goals and are pushing for a clean standalone increase. If the GOP plan stalls, bipartisan compromises may be required. Market reaction. Political uncertainty has pushed up the cost of insuring U.S. debt, reaching levels unseen since the 2023 crisis. Rising credit default swap prices reflect investor fear of potential default. On May 6th, in the Oval Office, U.S. President Donald Trump again addressed the China issue. Donald Trump, VO. The United States will negotiate with China at the appropriate time, he stated while meeting with Canadian Prime Minister Mark Carney in Washington. Trump reiterated, Donald Trump, VO. With the 145% tariffs, we've already eliminated the $1 trillion annual loss from bilateral trade. However, no top-level summit has been officially announced to date. On the morning of May 9th, Trump posted on Truth Social, referencing the upcoming Geneva talks, Donald Trump, VO, an 80% tariff against China would be acceptable. Markets interpreted this as a new inflationary threat, especially as the Federal Reserve maintains a wait-and-see approach. Behind the scenes, there's significant communication noise. PhoneGate. On April 25th, Trump claimed that Xi Jinping had called him and that negotiations were underway. 3 days later, China's foreign ministry denied it. No phone call or coordination took place. Multi-channel outreach. On May 1st, Chinese state media reported that Washington had made multiple diplomatic attempts to initiate talks, primarily to renegotiate the 145% tariff package. On Saturday, the two delegations will officially meet in Geneva, U.S. Treasury Secretary Scott Bessent and Chief Negotiator Jamieson Greer. China, Chief Economic Advisor He Lifeng. This could mark the first real step toward easing the tariff spiral, especially in the context of loosening export restrictions on AI chips. Key points to watch in the coming days. The phone denial and multi-channel diplomacy both suggest chaotic but urgent communication is ongoing between both sides. The Geneva meeting will be a critical test. Will it lead to gradual tariff relief, or will the 100 to 145% tariff regime remain in place? Trump's Truth Social post proposing an 80% tariff adds new uncertainty, potentially raising inflation and putting more pressure on the Fed's policy stance. In early April, the U.S. implemented a 145% tariff on Chinese imports. Already in the first month, drastic changes in trade volumes are visible. Shipments from China to the U.S. fell by 21% compared to April of the previous year. U.S. exports to China dropped by 14%. China responds with a dual strategy: adaptation and provocation. Despite the decline in trade with the U.S., China's overall exports increased by 8.1%, driven primarily by shipments to Southeast Asia, over 20%, and the European Union, 8%. Meanwhile, imports dropped by 0.2%, pushing China's trade surplus to $96 billion. Official statement from China's Ministry of Foreign Affairs: China is not afraid of a trade war but prefers peaceful cooperation. Current U.S. policies are unsustainable in the long term, and American consumers are already feeling the cost. Key takeaways. The tariff war is already reshaping global trade and hurting United States consumers directly. At the same time, China is strategically pivoting to new trade partners, while maintaining diplomatic pressure on Washington in official communications. On Friday, Donald Trump presented his 2026 so-called skinny budget proposal, which aims to cut non-defense discretionary spending by $163 billion, roughly 23%. Major policy shift in spending priorities: 13% increase in defense spending, 65% boost for homeland security. Meanwhile, dramatic cuts to education, housing and healthcare. Biggest cuts: housing and urban development, $33.6 billion, or a 44% reduction. The National Institutes of Health and the Centers for Disease Control and Prevention, both facing cuts above 40%. The IRS to be cut by $2.5 billion. At the same time, border security funding hits an all-time high. Political reactions. Democrats denounced the proposal as an attack on working families and the middle class. Several moderate Republicans criticized both the modest defense increase and cuts to winter heating assistance programs. Although the budget proposal is not legally binding, Trump's influence in Congress and the GOP's slim majority make the upcoming July negotiations highly consequential. Investors are closely watching how these talks unfold in the coming months. As expected, the Federal Reserve left interest rates unchanged at 4.25 to 4.50%. Trump's new tariffs could trigger inflationary pressures, so we're staying in wait-and-see mode. Market reaction, initial volatility, then gains. Dow Jones up 0.70%, S&P 500 up 0.43%, Nasdaq up 0.27%, SOX, the semiconductor index, up 1.7%, and Nvidia closed up nearly 3%. Trump's next-day attack on the Fed. Trump posted on Truth Social, adding that inflation fears are overblown. Powell is a fool who talks too much and won't cut rates. Late chip rally, semiconductor stocks soar on May 7th. In the final 40 minutes of the U.S. trading session on May 7th, a surprising and dramatic rebound occurred in the semiconductor sector. The catalyst? A single headline. Bloomberg reported that the Trump administration may roll back AI chip export restrictions imposed during the Biden era. This was later confirmed by a U.S. Department of Commerce spokesperson. The Philadelphia Semiconductor Index, or SOX, rose 1.7% in just 40 minutes, leading to a sector-wide rally by the day's close. Top movers included Nvidia, nearly up 3%, AMD, Broadcom, Qualcomm all posted strong gains. The action occurred almost entirely in the final 30 minutes of trading. What does it mean? Semiconductor production is now a geopolitical battleground, not just a tech issue. Investor response shows well-timed regulatory concessions can shift hundreds of billions in market value within minutes. The chip sector remains one of the most sensitive indicators of the U.S.-China relationship. Key question for the days ahead. Will this rollback of export restrictions actually begin, or is it just a trial balloon to test market reaction? Donald Trump stirred controversy again last weekend. On May 4th to 5th, the U.S. president proposed a 100% tariff on all foreign-made films, citing national security concerns. Industry reacts with confusion. The White House later clarified, no final decision has been made. However, reactions were swift. Film industry experts called the plan nearly unworkable, since modern Hollywood productions rely on globalized supply chains, including foreign filming locations, international crews, and mixed financing models. What's at stake? Analysts noted the potential consequences. The U.S. enjoys an approximately $15.3 billion annual surplus from film and TV service exports. About 70% of Hollywood's box office revenue comes from international markets. A wave of retaliatory tariffs could significantly harm studios and distributors. Market reaction May 5, 2025. The announcement triggered an immediate drop in media stocks. Netflix down 2%, Disney and Comcast approximately down 1%, Cinemark and IMAX down 1.6 to 2%. A divided Hollywood. Veteran actor Jon Voight voiced support for protecting domestic production, but industry analysts emphasize that the details remain vague, and a global backlash could do more harm than good to the U.S. film sector. Key question for the coming days. Is this a serious policy proposal or just another campaign-era test balloon? U.S. President Donald Trump and UK Prime Minister Keir Starmer described the newly signed trade agreement as a breakthrough during a joint announcement on May 8 in the Oval Office. The deal carries symbolic significance but also brings real economic benefits to both nations. Key points of the agreement, summarized. UK car export tariffs to the US will drop from 27.5% to 10% for the first 100,000 vehicles. Anything above that remains subject to Trump's 25% Section 232 tariff. The 25% US tariffs on British steel and aluminum will be lifted. The 19% UK ethanol tariff will fall to zero, up to an annual quota of 1.4 billion liters. In return, the US may export up to 13,000 tons of duty-free British beef. The average UK tariffs on US goods will drop from 5.1% to 1.8%. However, Trump's baseline 10% tariff on British exports remains unchanged. Trade impact and market reaction. According to the US government, this agreement unlocks $5 billion in new export potential, $700 million in ethanol, $250 million in beef exports. The news had an immediate positive impact on markets. The S&P 500 rose more than 1% intraday, ultimately closing around plus 0.6%. Analyst interpretation. This agreement strengthens Trump's trade credibility and helps ease tariff tensions, at least along the transatlantic axis. In April 2025, China's exports rose by 8.1% year-over-year, significantly outperforming analysts' forecasts of 1.9%. Meanwhile, imports dropped by just 0.2%, a much better result than the expected minus 5.9% decline. US-China trade relationship, sharp decline. Bilateral trade between China and the US has dropped significantly, exports from China to the US, minus 21%, imports from the US to China, minus 14%. Reason: the US imposed 145% tariffs and China retaliated with 125% counter duties. Growth drivers: ASEAN and the European Union. The increase in exports was driven by other global regions, to ASEAN countries plus 20.8%, standouts Indonesia plus 37%, Thailand plus 28%, to the European Union plus 8.3%. However, imports from the EU fell by minus 16.5%. Analyst commentary, front-loaded shipments and early warning signs. Experts suggest that the April export spike is partly due to contracts being fulfilled before tariff hikes took effect. Shipments rerouted through third countries to avoid direct tariff impact. The momentum is expected to slow in the coming months, though Chinese authorities have rolled out targeted stimulus packages to cushion the tariff war's effects. Looking ahead, Geneva talks. This weekend, delegations from the US and China are scheduled to meet in Geneva on May 10th. All eyes are on the negotiations. Will they de-escalate the tariff war, or could export market stability now be at serious risk? At the age of 94, Warren Buffett announced that he will step down as CEO of Berkshire Hathaway, effective January 1, 2026. Greg Abel, previously head of Berkshire's energy and infrastructure businesses, will take over. Buffett will remain chairman, but day-to-day operations will be transferred to Abel beginning in January. Immediate market reaction: BRK share drop. The announcement triggered an immediate decline in Berkshire Hathaway's Class B shares, BRKB. During the day, they fluctuated between minus 4.9% and minus 5.2%. The closing price was down about minus 5%, which translates into an estimated $59 billion drop in market capitalization in a single day. Analyst: insight expected, yet surprising. While the succession plan had been well known for years, the timing of the announcement still came as a shock to the markets. Analysts emphasize that Buffett's iconic status and market-shaping influence means that even a well-planned leadership transition can spark uncertainty. A reassuring signal, however, is that Buffett will remain as chairman, which could help stabilize investor sentiment and indicate continuity for long-term shareholders. Key question: will Greg Abel be able to carry on Buffett's legacy in a completely transformed market environment? The Walt Disney Company, or DIS, is one of the world's largest media conglomerates. It operates across film production, television broadcasting, theme parks, and digital streaming platforms like Disney Plus and Hulu. Earnings were released on May 7th. Disney reported steady subscriber numbers across its streaming platforms. However, theatrical releases underperformed, putting pressure on the studio segment. Investors reacted positively to stronger-than-expected performance in the direct-to-consumer unit, which includes Disney Plus. The stock surged 10% following the announcement. Next, we have Netflix, or NFLX, the global streaming leader with over 260 million paid subscribers, known for its original content and international expansion. Earnings were released on April 17th. Netflix posted a 13% increase in revenue and a 24% jump in net income, outperforming expectations. The majority of new user growth came from international markets. Original content and successful regional series were key growth drivers. Palantir Technologies, or PLTR, provides advanced data integration and AI-driven analytics software for defense, intelligence, and healthcare sectors. Earnings were released on May 5th. Palantir's revenue climbed 36% year-over-year, showing strong demand for its AI solutions. Despite the top-line growth, concerns about the stock's valuation led to a sharp sell-off. The stock fell 15% following the report. Next up, Advanced Micro Devices, or AMD, develops high-performance CPUs, GPUs, and chipsets for servers, gaming, and AI-focused computing. Earnings were released on May 7th. The company benefited from AI-related tailwinds, though performance varied by product line. Strength in data center products was offset by weaker results in client and gaming segments. Then we have Arista Networks, or ANET, which designs and sells network switches and cloud connectivity solutions for large-scale data centers. Earnings were released on May 7th. Arista reported strong growth from hyperscaler customers. The company is expanding its market share in cloud infrastructure and enterprise networking. Next, Shopify, or Shop, offers e-commerce infrastructure and software tools for online retailers, including payment processing and logistics support. Earnings were released on May 8th. Shopify delivered solid results in both e-commerce and cloud-based solutions. Revenue and customer growth were both ahead of analyst expectations. Lastly, Coinbase Global, or Coin, operates the leading US-based crypto exchange servicing both retail and institutional users. Earnings were released on May 8th. Trading volumes remained subdued amid lower market volatility. Still, Coinbase delivered relatively stable financials and maintained its user base. Vertex Pharmaceuticals, or VRTX, specializes in treatments for cystic fibrosis and has begun expanding into gene editing and therapy. Earnings were released on May 5th. Revenue declined 13.99%, driven by competitive pressures in the US market. Pricing and insurance coverage dynamics also weighed on results. Next, BioNTech, or BNTX, is a German biotech best known for its mRNA-based COVID-19 vaccine co-developed with Pfizer. Earnings were released on May 5th. BioNTech saw a continued decline in vaccine-related revenue. Oncology and other mRNA pipeline projects are in early development with no major revenue impact yet. Williams Companies, ticker symbol WMB, owns and operates a major natural gas pipeline infrastructure across the United States. Earnings were released on May 5th. Revenue dropped 6.78%, attributed to lower gas prices and seasonal demand fluctuations. Enbridge, ticker symbol ENB, is a major Canadian energy infrastructure company with pipeline operations spanning oil and gas transport. Earnings were released on May 9th. They reported steady performance in core operations and announced strategic growth plans to expand their footprint in the US market. ConocoPhillips, ticker symbol COP, is a global energy company engaged in the exploration and production of oil and natural gas. Earnings were released on May 8th. Profit margins were squeezed due to a drop in international oil prices, and capital expenditure and production guidance were slightly revised. Ford Motor Company, ticker symbol F, is a leading American automaker producing combustion engine and electric vehicles, as well as commercial trucks. Earnings were released on May 5th. The EV division posted losses due to cost inflation and slower sales, but traditional vehicle segments remained profitable and stable. Ferrari, ticker symbol RACE, is a luxury Italian automaker known for handcrafted sports cars and premium performance branding. Earnings were released on May 7th. They reported strong demand globally, and the order backlog reached new record highs, ensuring production capacity remains fully booked. CRH plc, ticker symbol CRH, is a major supplier of construction materials, concrete, asphalt, and cement, with significant operations in the U.S. Earnings were released on May 5th. Strong demand continued across U.S. infrastructure projects, and forward guidance was positive, citing federal funding programs and urban development. Ares Management Corporation, or ARES, manages alternative investment portfolios across private equity, credit, and real assets. Earnings were released on May 5th. They reported near-record capital inflows into their private credit funds, with continued investor interest in alternative yields amid uncertain equity markets. Berkshire Hathaway, known by its ticker symbols BRKA and BARK.B, is a conglomerate run by Warren Buffett, investing across insurance, transportation, energy, and technology sectors. Earnings were also released on May 5th. Unfortunately, operating profit declined by 14.1%, largely due to insurance underwriting losses. Notably, the company officially confirmed that Greg Abel will succeed Warren Buffett as CEO in January 2026. This content was created with the help of AI and does not constitute investment advice. In today's market environment, the outcome of the US-China trade negotiations could prove decisive. If the weekend summit can be framed positively, or even just trigger a hopeful tone, the stock market could easily surge upward. On the other hand, if harsh rhetoric or signs of conflict leak out, the market could respond with a dramatic sell-off. Right now, it's basically a coin toss. Short-term market direction isn't driven by fundamentals but by diplomatic sentiment. Personally, I would prefer to wait and observe. This is not investment advice, just my personal view. A potential dip could create attractive entry points, especially in sectors that remain fundamentally strong, but might become oversold during a broader panic. Ultimately, I believe an agreement will happen. It has to. The question is when, and on what terms. In my earlier videos I've explained in detail that there are still many open points on the agenda: tariff reductions, AI chip regulations, tech export restrictions, and agricultural quotas. All of these require intense, separate negotiations. That's why I expect a gradual, layered deal, not a single breakthrough. But the market wants immediate signals, and in their absence, sentiment can shift rapidly. Waiting is sometimes a strategy. Look past the noise and follow the process. Now let's take a look at how my fictional portfolio is performing, comparing 3 different investment strategies in the same market conditions, with the same starting capital $15,000. Strategy 1, lump sum, one-time investment. The first investor bought an S&P 500 ETF on January 2, 2025, investing the entire $15,000 at once. They've held the position ever since. No additions, no withdrawals. Current performance, minus 3.70%. The blue line reflects this result based on the most recent Friday closing price. Strategy 2, dollar cost averaging, gradual investment. The second investor splits the $15,000 into 12 equal parts, investing $1,250 on the second trading day of each month into the same S&P 500 ETF. This approach helps smooth out volatility and reduces the risk of poor entry timing. Current performance minus 2.99%. The green line reflects this strategy, slightly outperforming the lump sum method so far. Strategy 3, my fictional portfolio. This portfolio is based on my own stock picks and investment decisions. It launched on March 19, 2025, with the full $15,000 invested in various individual stocks over multiple transactions. I've explained my choices in earlier videos. Current performance minus 1.90%. However, it's important to note, all my positions are currently in cash, meaning I'm not holding any stocks right now. I'm waiting for the right moment to re-enter. Note: these performance metrics exclude broker fees and taxes. They reflect only market-based price movements. Thank you for joining me in this in-depth video packed with market analysis and portfolio insights. Now it's your turn. Which investment strategy do you find the most convincing? And where do you think the market is heading in the coming weeks? Drop your thoughts in the comments. I'm curious to hear your opinion. If you found this video helpful, please like the video, subscribe to the Test Portfolio XSX channel, and hit the bell icon to stay updated with the latest market insights and video uploads. Sources referenced in this video: Reuters, AP News, The Wall Street Journal, Financial Times, ISM, B.gov, Investopedia, and CNBC. These sources are always listed in the video description to ensure clarity and legal transparency. That's it for today. Thank you for watching. I'll see you in the next episode where we'll break down more economic developments, earnings results, and portfolio updates together. Adios. Before you go, here's a quick teaser of what goes on behind the scenes at Test Portfolio XSX. From late-night research sessions to crafting detailed analysis, our journey is as exciting as the market itself. Stay tuned for a special behind-the-scenes video coming soon. Thanks for watching and see you next time.